Welcome to the Storebrand Global ESG Plus webinar. Great to see that so many of you can make it today. My name is Spiros Allen and I'll be your host. And I'm joined by Henrik Wold Nilsen, who is the portfolio manager. We plan to use about 40 minutes today. We're leaving us a little bit of time for Q&A. So please send us your questions. You have the chat function that you can use, and also note that you can be anonymous. One thing to mention before I pass on the floor to Henrik is that the presentation will be sent subsequent to the presentation, and we will also provide you with a link to the recording. Finally, worth mentioning, today is actually pretty much the 5-year anniversary since the launch of the strategy. It has grown substantially in that time, so now we're at about 6.1 billion euros for the whole family of Plus funds. And for the strategy that we will talk today, we have about 3.8 billion euros in total. So, Henrik, the floor is yours.
Thanks a lot. So, normally, I will first show a presentation of the results for the first quarter, followed by a deep dive into a topic relevant for the fund. And today it is about climate solution companies and how we find those, and some reflections on how to go from a list of companies to a portfolio with weights. This quarter has been a bit like a reversal from last year, at least for some of the themes the fund is exposed to. In terms of absolute returns, it's been rather following up on the good performance of last year. So in euros, it's 10% up in absolute terms, which you can see on the left-hand side, with the portfolio being green and the benchmark in blue. And as you can see, the two follow each other quite tightly, as you would expect from a near index fund, low tracking error fund. On the right-hand side, we zoom in on the differences. And there you can see that February was a tough month, but in total for Q1, then we are just behind the benchmark. And that comes after very, very good 2020, where we were 3% ahead. And we will see that some of the sources of excess return last year have turned negative this year, but have been compensated by other effects. So we'll get back to that. Since inception then of the fund, which is 4 years ago, Alan mentioned that the strategy itself is 5-year. That's the oldest vehicle, the Swedish one. But this Norway domiciled one is 4 years old yesterday. And since then, it's 1.7% annualized ahead of benchmark. And then in Q1, it was minus 0.14%. The backstage during Q1 in terms of fossil fuel prices, I mean, we are short fossil fuels since it's a fossil-free fund, obviously, and then it's negative for the fund's relative performance if fossil fuel prices increase, and they have been doing so this year, and of course that's related to good news that the vaccines are really improving the situation, at least in the Western world, for regarding the pandemic, but for the fund seen isolated, then it's not good for relative returns when fossil fuel prices are up. So on the far left, it's the oil price. In the middle, it's gas prices. And on the right is the coal prices. And all of these are now at the pre-pandemic levels, after having risen substantially on the very late 2020 and in particular this year. Over to more climate-related time series, or climate-positive time series. On the left-hand side is performance of a measure of global green tech companies in white versus the broad market in orange. And you can see that last year was spectacular performance for the clean tech companies in white, but that this year has been a reversion, substantial reversion. So parts of the gains from last year were given away during Q1. But only parts. And on the right-hand side is the emission quota price in the EU, the price to emit for industrial sectors. So there it's good for climate. If these increase, then it's more expensive to pollute. And you can see in the middle of the chart that when the pandemic arrived, these plummeted because people expected the economy will stop. And then there is less demand for being the polluter. And this is actually what happened after the financial crisis, that when the engine of the economy stopped, then nobody wanted to pollute, and this price just collapsed and stayed low for many years. But this time around, this was not the case at all. There was an initial shock when people feared that the pandemic will make trouble for efforts to mitigate climate change. But actually, both EU and now Biden has more framed climate mitigation as a way to create jobs. So actually an answer to the economic problems. And not that climate mitigation is something you do if you have excess money, and if times are tough, you forget about it. So the opposite has been the case this time around, and quota prices have increased to really high levels. Yesterday it was 47 euros. And this has had a big effect on, in particular, electricity markets in Europe. And this is just an example of the kind of effects that we hope for with this fund. So this is what this fund is positioned for relative to benchmark. So that's why I use it as an example. On the left-hand side in the table, there you see electricity prices. And the first line, that's the price you get for selling electricity in Germany. And 4 years ago, when the Norwegian domicile fund was created, then then it was 30 euros per megawatt hour. And now the price is almost double that, 57. And the price of coal is flat. That's the same price as it was then. So then you can imagine from those two numbers that if you're a coal power plant operator, this should be great, right? The price of your product has doubled and the price of your raw material is flat. So you should be making a financial jackpot here. But that's not at all the case, because you have a new cost, which is the cost of being the polluter. And this has increased a lot from 5 euros per needed per megawatt hour produced if you're a coal power plant to 39, so almost 10 times as high. And then your profit margin as a coal power plant operator, it used to be slightly positive, but now it's actually twice as large, but negative sign. So you lose minus 5 euros per megawatt hour you produce. And of course, this has led to many coal power plants being shut down. And that's the whole intention behind this pricing mechanism. So it's a really great example of carbon pricing working. And it has worked a lot faster than political initiatives to shut down power plants. And on the right-hand side, then you see the implication of the market share of various electricity production mechanisms or technologies. And the black dotted line is coal, and you can see it has totally plummeted over the last 2 years after this. There was a reform in the way these prices are set, and that led to a spike in prices, and then it has had massive consequences, almost a 50% reduction for coal. And on the other hand, you have a carrot as well as stick, and the carrot is given to renewable energy producers, and this is in green dotted line, and that has increased a lot. It took over coal's position 2 years ago. And in total now, renewable energy, including biofuel, then, is ahead of the sum of all fossil fuel producers. So it just shows that this kind of carrot and stick strategy really works. And this is the motivation of our fund, to pre-position for this kind of mechanism being broadened to other parts of the economy, and also in terms of geography being adopted in more parts of the world. Either via pricing or via regulation and policy. But this is what we want more of in our fund. And if you look at the political backstage, that has had some positive development so far this year, in particular with the United States returning to the climate stage as a constructive partner. Biden had promised this, and he has, so far it seems, delivered very good progress on it. And in the EU, this train has been moving steadily, with the climate law being finalized a few weeks ago, and the Green Deal has passed significant hurdles. And also relevant for the financial sector, then the whole push for the sustainable finance packages have been moving forward, and in particular with the EU taxonomy. And this is a good backstage for our fund, although during Q1 we were hit a bit by the reversion of the spectacular last year. So if we look in the table on the left-hand side, there we break down the contributions to excess returns. And I've circled in red marking the most relevant parts. So being fossil free last quarter, the official screen cost us 0.4%. And then for consistency reason, we also avoid some more companies which are in the value chain or have similarly negative climate exposure. And that was another 0.12%. So 0.5% due to fossil companies having good performance in Q1 as opposed to last year. And being heavily overexposed versus the benchmark to climate solution companies, that was a negative contribution during Q1 of 0.3%. However, the rest of the portfolio, the 90%, which is not climate solutions, delivered 0.8% outperformance contribution, basically neutralizing the other negative effects. So the fund as a whole was just slightly behind the benchmark with 0.1%. And this all else contribution of 0.8, that's a mixture of many different effects which are hard to dissecate, to separate into the separate effects, but it's the sum of everything that has to do with risk management. And also all the tilts that are built into this part of the fund, being a preference for low carbon footprint, good ESG properties, overexposure to companies with good third-party verified climate plans via the Science-Based Targets Initiative dataset. And also that we have a preference for green revenue, motivated by, it's very similar to EU taxonomy. So we have this pure play climate solution portfolio, but we also capture the more, not as dark green, but the a bit green companies via this preference for high green revenues for the rest of the fund. And the sum of all these effects was positive 0.8, and that sort of saved the day during Q1. If you look at single companies on the lower left, there you see the top 3 positive and negative contributions. Not owning Tesla was actually the best contributor last quarter. It's excluded for labor union rights. Plug Power is a hydrogen company in the US, and it was going against the stream by being actually positive during Q1 due to an investment from a large Korean company in that into Plug Power. And Walmart also excluded for labor rights, plus 5 basis points. But you see that the single stock effects are not large. It's 0.1% being the very largest contributions and very few above 5 basis points. And that's what you want in a low tracking error kind of fund, that you have a little stock specific risk and more thematic risk from the climate themes. And on the negative side, we lost by not owning ExxonMobil, and also Brookfield Renewable, which is a large renewable electricity operation company. And there was a chip producer that we were underweight. That's more a bit more random. Chips were in hot demand during the last quarter. There was a lack of microchips, and we didn't own that particular company. So that cost us 6 basis points minus. On the right-hand side is the summary since launch of the strategy. So the Swedish domiciled one with the longest track record since 2016. So 5 years passed a few weeks ago. And Q1 didn't really change the picture. So you see on the time series that it's well ahead of benchmark, and the main contribution comes from the fossil fuel screen in orange. And the next one is the green one, which is climate solutions companies. If we zoom on into the different themes in this climate solution group, then we have a 10% allocation to this kind of companies, and it's split between different themes, with the largest one being renewable energy. And this is just a reminder from what happened last year. And then you see the red columns per theme, that's the most relevant. That's the equity specific contribution. The gray is currency, which is neutralized by other parts of the portfolio. So it's really the red one, which is specifically the effect of these allocations. And then you see renewable energy last year was really good, 4% plus. Green transportation was poor due to social distancing, meaning that our public transportation exposure was a bad idea. But in total, then it was a lot positive, 4% nearly. If we look now at the effect in Q1, it looks like this. Green transportation is on the left-hand side. So it flipped sign compared to last year. Now it's actually a bit positive. And similarly, renewable electricity also flipped sign. It was now minus 0.5% last year. And the other themes were all slightly positive. So it's a reversal from last year, but with smaller effects. And one thing to note there is that we continuously do risk management on this part of the portfolio, meaning that the high flyers from last year that had really good performance, we will tend to have been selling those during the upturn, because if the price doubles, our weight doubles, and that leads to too much risk for our model. So it will tend to sell these stocks. So in that sense, we're less exposed to the downturn than we were on the way up, really. And also we have a 10% cap on this, more or less, this part of the portfolio. And we have therefore been net sellers over the last 2 years, since it has been increasing above that. So we have tended to sell or buy less if there is inflows, taking profit from it. Okay, let me just have a look at the clock. So it's 15 minutes spent, so we're well on track. So we can move on to a more thematic deep dive. So this is not related to Q1 as such. It's more a description of a particular part of the strategy. Like mentioned, we allocate 10% approximately of the fund to pure play companies within who provide fixes for the climate crisis. So products and services that you really need a lot more of if you want to be able to get anywhere close to the Paris Agreement targets. And we've often been asked, how do we determine which companies qualify for this allocation? And it's not so easy to answer because we use many different approaches. And I thought I should use this opportunity to summarize most of these approaches that came to mind when we pulled this material together. I have myself been a central piece in this work to build up this library of stocks. But we have now also started a dedicated team within Storebrand Asset Management who have as their main job to upkeep this list and to expand it. The way we've done this work is first to get a macro top-down view of what kind of products do you need to make advancements towards the Paris goals. And luckily, there are many different sources that you can use to get an idea of what you need. It's scenarios from IPCC researchers. In the UK, they have a dedicated scientific advisory committee, which should help the government to make the correct choices regarding reaching their climate goals. So it's called Climate Change Committee. They make very good material of translating the targets into specific steps that you should take. So that's good material to look at. Similarly, you have an organization called Project Drawdown, and they are motivated by the same thing, making a list of available technologies which are currently available and maybe with future advances built in, but to estimate then what are the potential for carbon emission reductions from each particular technology. So I've been going through this list and trying to identify then listed companies within each theme. Then you can follow the whole EU machinery and see what they are talking about, what kind of products they identify as needed. The Green Deal, who can get financing, and also the EU taxonomy has really detailed descriptions of which companies are contributing to Paris Agreement implementation. And they also have a lot of nuances about how strict limits should you place on the quality of greenness within each industry for this to qualify. Then there are dataset providers, and we buy the dataset from FTSE called Green Revenues, and it's motivated by the same thing as the EU taxonomy, to be like a library of the exposure of each company towards a high resolution categorization of the different green themes. There are indices like Wilder Shares produce one, which is Clean Energy Technology Index. So you can look at the constituents there. You can also look at the ETFs and pure play funds within clean tech climate space to look at what are they investing into to get ideas. Once you have found a company, you can look at holdings data in Bloomberg to see who else is owning this company. And then you can look one step ahead and look what is these other co-investors that you have, what else do they own? So if they are into this segment of the market, then you can look for inspiration in what else do they own and probably find something you had been missing there. And also you can be looking at annual reports. Companies usually list who is your main competitors. So many will be private companies, but maybe you can find some listed ones that had previously passed, you had failed to notice. So, and then following Bloomberg New Energy Finance as well, they produce a lot of reports on the low carbon transition, and they also link it up to relevant listed companies. So it's not an easy question to answer. How do we compile this list of companies? Because it's a multi-pronged approach. But it's also a part of my job that I really enjoy, because there are so many interesting companies out there in this segment, and also new companies coming to the market. So it seems like I have a blank screen. I have no idea why the next slide is not containing information. I'm afraid it seems like I will have to close this down and instead open the underlying PowerPoint file. This was a PDF that I exported. So bear with me for a second while I open that, close the PDF and switch sharing to the PowerPoint file. But what follows now on the next slides is that I will go through some of the companies that we have included. I will show you wind power plants, what companies we have included in our fund, and how many of those are part of MSCI World. Because a key point here is that to really get a good broad diversified exposure to these themes, you need to be looking outside of MSCI World, because this is a growth theme. So not all of these companies are currently within MSCI World. But there are so many opportunities if you look outside of MSCI World. So now I hope that you are seeing my PowerPoint slides again. Yeah, Alan gives a thumbs up, so I will be full screening it. And this is the overview that we have over our totality of climate solutions companies. So it's not everything EU taxonomy relevant, because we have EU taxonomy exposure also in the rest of the fund. But this is pure play companies, so more than 50% of revenues typically coming from the relevant thematics here. And the large, approximately a third of it, as you can see, is renewable energy. And the second biggest one is green transportation, or low carbon transportation. Energy efficiency in the building space mainly. Access to clean water, that's more like dealing with the consequences of climate change rather than preventing it from happening. And then recycling. And then we, in this wheel, if you move one step further out, you can see the sub-classification: wind, hydro, solar, hydrogen, public transportation, and so on. And the idea here is to capture as much as possible of the relevant companies, and also to be highly diversified. And we use the the tracking error minimization process to determine the weights that we have. So it's not my subjective view or belief in each of these themes which determine the weights. It's rather the composition of these exposure, which results in 10% weight, but also the lowest possible tracking error. So we are risk averse here, since we are index-like. And it's not an attempt to make an active portfolio. I'm not timing this. I don't have a view on the return of each company. My only view is, do these companies have the majority of their exposure to products and services which are highly needed for solving the climate crisis? And we have a quite narrow definition of that to get a really pure exposure. So moving on, we will look now at the wind power companies. So that's one of the large parts of this. If you look at the fund as a whole, it's 1.1%, but that means it's above 10% of the climate solution portfolio seen in isolation, but it's 1.1% of the entire fund. And then you can see we have a long list of companies here, and you can see the countries they belong to in the third column, and it's quite diversified in terms of geography: Canada, Portugal, Denmark, so Europe, you have Asia there with Hong Kong, Japan. So yeah, it's we try to find this across the entire globe. And if you look on the next column, the first one with numbers, that's the market capitalization of each company adjusted for free float. And the bold face line there, line number 3, that's Vestas Wind. And that's by far the largest one, $40,000 million, so $40 billion. And that's the only one which is part of MSCI World. And in the wind segment, you also have Siemens Gamesa in MSCI World, but that one is screened because they have been investing in West Sahara without clarifying this with the local population. It's occupied territory by Morocco, so it's highly controversial to be investing in occupied territory, and we across Storebrand avoid investments in companies which do this and are not willing to have dialogue with us on taking steps to prevent it from happening again. So Siemens Gamesa was excluded a little while ago from all investments across Storebrand. And that's also in the EU taxonomy, that's also part of the deal there, that you should have exposure, but you should also not be causing other trouble. So they have a filter in place, so it's aligned with that way of thinking. But back to the main table, you can see that many of these companies are pretty small, but then we also have a smaller weight in the fund. So if a company is really large, then it is liquid and in agreement with index market cap philosophy, then you invest more in the large companies and less in the smaller ones. In most of these, everyone except Vestas is not part of MSCI World, but if you would include them into the market cap weighted benchmark, so you just add them onto the MSCI World, they would have a weight of far below 1 basis point, 0.1%. So to make sense of including them, you need to invest a lot more than what the market cap alone dictates. And on the far right, the last column, it shows our multiplicity, our weight divided by the weight you would have if you were market cap weighted. And then we are typically at 20, 30, 40 times overweight compared to the market cap alone. And that illustrates our positive view on these kinds of companies. And the next slide is just exactly the same kind of information, but for energy efficiency. And I don't mean that you should digest all of these numbers. It's maybe a bit overkill, but it's just to give you a taste of how many of these companies are not part of MSCI World. In the building space, then it's about efficient heating. So using electrical heat pumps is a key way of reaching Paris targets for this industry. And insulating your walls. There you have Kingspan and Rockwool in particular, but also some other companies in that segment, and producers of windows. The majority of the window market is actually refurbishing or improving energy efficiency. One interesting fact about buildings is that, of course, they live for a long time. So it's not enough just to have very strict rules for whenever you build a new building, that it should be great on energy efficiency, because then it will take you 50 to 100 years before your entire building stock is up to speed. And we don't have that time for implementing Paris Agreement. So a big part of the EU Green Deal is actually to renovate buildings. So they want to increase the renovation speed by a lot. And then these are the companies that stand to benefit from this. The last example is public transportation. That was a bad idea last year to be overweight public transportation due to COVID and social distancing. So many of these companies had a tough time. But for the fund as such, we earned a lot more actually on the flip side. We were lucky on the oil price, not owning oil. So in total, we were happy or lucky during the consequences of a pandemic on the portfolio, but this was in isolation a very poor bet to have. And here we own the operators of public transportation. and also a lot of hardware producers, the companies that produce railroad hardware, for instance. And here about a third of it is within MSCI World, and the rest are smaller companies. So that's what we do, try to continuously find as many of these relevant companies as possible. And if we show all of it then, we need something more graphical. We are fed up with tables by now, and it would be a huge table to show with 140 companies in it. So we try to illustrate it with this wheel kind of figure instead. And the takeaway here is just that we have a little bit invested in really a lot of different companies. And that's in line with the idea of an index fund, that you should be highly diversified. And actually, most of these companies are not member of MSCI World, 113 out of the 140. And if you look by invested amount, then 60% of our investments in assets in this segment is outside of MSCI World. And that's really necessary to get a diversified exposure. And just wanted to point out that increasingly, probably driven by EU taxonomy, there are more and more funds which do the same as we have been doing here, trying to overweight climate solution stocks. But it's not easy to compare always, because you are, at least until EU taxonomy is in place, then you are free to make your own definitions, what is green, etc. And there is quite a wide variety of takes on this, and to what extent are you puristic in your definition or inclusive to get a higher number. And we have chosen to be quite puristic. For us, it's really about climate change being the key return driver for companies. And on the left-hand side is an MSCI climate change strategy. If you stick within MSCI World, it's harder to be as diversified as we are. So you can see that nearly a quarter of or above a quarter of the exposure is just one company, Tesla, and that then more IT-related companies are often quite large, and they don't qualify for our definition. And they do, though, for EU taxonomy. Everything to do with data centers qualify in the EU taxonomy, because energy efficiency there is really important. The same with real estate companies, if they are doing BREEAM certification, etc., or energy efficiency certification. But in my view, that then climate change is not the make it or break it, the key driver for the performance. So you can say they are green, or they should behave in a certain manner and be energy efficient, and that's important, and that's what the EU wants to motivate. But it's not the key driver for performance. So for me, it's more about having financial exposure to the implementation speed of Paris Agreement, rather than having a binary, this is green, this is not green. Because then you miss out on the financial exposure and what is your leverage to this trend. We also buy data sets from FTSE Green Revenue, and they have a better coverage. So out of our 144 pure play companies, they cover nearly 2/3 of it, but they miss 50. And parts of that is because they are smaller in market cap than what FTSE have been covering so far. And partially it's companies which are newly listed. So IPOs, then there will be a quite substantial time lag until data providers have them covered. And we want to invest sooner than that. So here is a list of example of companies then which are not covered by FTSE. So in the UK, Trainline is a company which let you book tickets on different railroad companies, for instance. And Zoom is relevant for the technology we're using right now, although we are on Teams. And that was IPO'd in 2019, and then the data providers have not always taken on coverage yet. Stadler, they are making railroad hardware, so they are producing trains which are commonly used in the Oslo region where I live. That's the popular train. That's the one you want to arrive because it's quite efficient and on time usually, not prone to breaking down. And it's also used in the UK for several operators. Excel, they are producing electrical bikes. Systemair, heat pumps. Steiko is a favorite. They make insulation material for buildings, but they do it from biomass. All the others have high scope 1 emissions because they need to heat their material a lot. But Steiko, they use biomaterial for it. So it's really the greenest way that you can improve energy efficiency. So there are many different very interesting opportunities in the small cap segment. And you can see here an overview of how we have been working with this over time. On the right-hand side is our 2 lines. The dark green line, that's the portfolio weight allocation to the segment. So we started doing this in 2017. And we actually got the idea via dialogue with stakeholders. I was talking to a finance person in WWF, the NGO, and he said he liked our product, which was then fossil free. But what he was really missing, felt we needed to improve on, was exposure to this kind of companies, because that's what you need. You need risk capital willing to take exposure to the solutions for the climate crisis, not just distancing themselves from the sources of emission. And we thought that was a good idea, so we started doing that. And in the beginning, then we had 60 companies. That's the turquoise line. Since then, the weight has increased from 7% up to 10%, where we have kept it. What has increased a lot more is actually the number of companies in this segment, because we have been trying to find as many as possible. And in particular, in late 2019, early 2020, we took on coverage of smaller companies. We had a new way of trading them by being more hands-on and using algorithmic trading instead of trading via the large London brokers. So then if you allow yourself to use a little bit more time to implement your trades and be a bit more hands-on, then it's a lot easier to take on exposure to these smaller companies. So then the number of companies has increased to now pushing 150. But you see that the total weight has stayed 10%. So that means our diversification has increased, taking down then the risk from this. Talking about diversification, then and liquidity management is important because you don't want to have a huge weight in a very small company, then you become illiquid. And a key part of this fund is that it should be highly liquid, and clients should be able to consider this as a substitute for their normal index exposure. And then you need to keep control of your liquidity, and in particular when you go into smaller cap companies. So this again is the windmill companies on the left-hand side. And I noticed earlier that we are 20, 30, 40 times higher weight than what the market cap would indicate. And that's shown also in the 2-dimensional chart on the right. These dotted lines, they show your multiplicity of the market cap weight. If you would, all the dots, all the companies would be on the diagonal, which is to the lower right. That's where your fund weight is equal to the market cap percent. So then you're a normal market cap index fund. But if you go upwards, like we have done, then you have a higher multiplicity weight in these companies. So you are overweight 5, 10, 20, and 40 times. That's the different colored lines. And that's good because then you get higher exposure to them. But you need also to make sure you don't go too high, because then you will have too little liquidity in your strategy and you would not be able to use it as an index-like fund. On the next slide is the same for all of these climate solutions companies. And you can see that what you want is to have a proportionality, that there is the black dots, it's like a cloud, but there is a clear trend that when you go to the right, you go upwards. So your weight is proportional then to the market cap weight. And that means that you have control of your liquidity needs. So we have taken this directly into the portfolio construction methodology. And this means that it's still a highly liquid portfolio, and we're also able to adjust the liquidity as we see fit, as our need is. For a hypothetical £100 million redemption, then we could liquidate the entire corresponding part of the portfolio, including these climate solution stocks, and still be below 15% participation in the market volume, and that would be entirely okay. And for 1 billion UK pounds, as an example, then you could liquidate 93% of this particular part of the portfolio, and that's the least liquid part. So the rest of the fund would be fine. So you would be left only with a few percentage points of the assets, which you would need more than 1 day to sell. With 15% participation. So it is highly liquid, and that's by construction. That's what we want it to be. So to summarize, the performance during Q1, it was a bit of a reversal of the trends from last year, at least under the hood. So fossil fuel screen cost us money, and we also lost money on being long green companies, in particular renewables then. But it was offset by a good performance from the rest of the fund, including the various tilts that we have in place. So a mixture of risk management and positive climate and ESG views. And in totality, it was just 0.1% behind the benchmark, and the absolute performance was very good, 10% up measured in euros. And in terms of climate macro news, then it was actually a good quarter. You had Biden and the Democrats winning the 2 last senator seats in early January, which you might remember was a big and unexpected happening. That means that they have a lot more opportunities on making legislation on climate. So, but that coincided actually with the peak of the clean tech stock performance, because it's often the case that you buy the rumor and you sell the news. So then people have been taking profit in that segment. But in terms of longer term indications from policy news, it's been really good with the US returning to the table, and with the big conference call they had last week being a good indicator that things are moving in the right direction. Maybe not fast enough, but the trend is definitely on our side. And in terms of strategy, we didn't do any changes, major changes to the strategy, only just adding a few climate solution stocks to the list, but nothing bigger than that. And we have gone through then in depth the climate solution strategy we have in place, so 10% allocation for the fund. And noted that in particular the exposure to off benchmark, the smaller companies, are really a key feature of our fund, and it's also a differentiating feature versus many funds out there. And so are our quite strict puristic interpretation of what does it take to get on this list. We have quite a narrow, picky definition, and we're able to do so since we have recruited so many off benchmark companies in this segment. So that's it for me. Back to Alan.
Thank you, Henrik. We have actually gotten several questions, so I'm going to try to read through all of them quickly. Starting from one actually that I got here through email actually. There's been a lot that's been talked about since you had your last call with regards to the SFDR and the classification of funds. Your fund is classified as Article 8. Can you comment your thoughts around that and what you think both about your fund but also about what's happening in the industry and how that affects, I guess, passive funds like yours?
Yeah. So as we know, the intention behind that rule set is to prevent every asset manager being able to make their own definition of sustainability. And that has been a challenge as this space has grown more popular. Then you have seen various definitions being made which are not directly comparable. So EU has, of course, this effort then to try to pull all the strings together and make their own definitions. And SFDR, that's then like the disclosure rules for asset manager to categorize their ambition level in terms of sustainability for each product. And the highest one is 9, second highest is 8. And unfortunately, they have not really specified in that much detail exactly how you should interpret things. So there are many, there is a lot of room for different houses making different calls on this, and it remains to be seen what like the market-wide convention is. And I suspect the EU wants also the market then to make their own interpretation of it and sort of agree in an iterative process. So for the beginning, we have classified it a bit conservatively as 8, and our idea was that this is an anti-greenwashing exercise. So maybe you should be a bit defensive on it to make sure that you are not actually doing greenwashing in exactly when you're implementing an anti-greenwashing tool. And also intuitively, we thought that this fund is to first order, right? It's giving you MSCI World exposure. That's the main bet. But then you deviate. You have an active share of 30%. So you deviate very specifically and quite a lot, motivated by climate. So all your deviations from MSCI World are tools which would qualify for category 9. So it's just a question of, does the fact that you take MSCI World as a starting point mean that you should be 8, or should you only consider the active choices you make on top of that, and then we would be 9? And we have seen different funds in this segment landing on different conclusions. Some have said 8, and some have actually said 9. And of course, then we need to monitor how different peers of us are approaching this, and if it turns into like a market-wide consensus of what it is. Because I would say our fund is 8.5, and then you can round it up or down. It seems, and both might be consistent with the fine print of the rules. But so far we have been conservative on that.
Thank you. Okay, moving on to the next question. How does your investment universe, stock hunting ground, have changed in the last 6 months? And do you have any predictions on the next 6-month change?
Yeah, so I mean, to first order, we are MSCI World Universe. It's only for this climate solution universe that we go below that in market cap. And it's not every week that we find anything new, because I think our coverage is really good in this space already. You of course have IPOs, meaning that new companies come to the listed stock market. So monitoring for that is a continuous exercise. And one particular thing which has been talked a lot about in financial media is these SPACs, these entities where a seed investor, they create a listed vehicle, which is just a pot of money, and then they go hunting for a private company to take over. So it's like a backdoor onto the stock market. And this has been used a lot also for climate solution companies, like electric vehicle producers. And so far, my take on this has been that we don't want to invest in these companies. We did actually early days, we did before this really got onto our radar. But after having looked at this a while ago, then we figured out that there is not enough scrutiny on this. So they are listed, but they are not exposed to disclosure requirements, which of the normal quality level that you need to have for an IPO. So I see it as a bit risky. Some of these companies might be great and big winners, but others are a lot of hot air. And when I've looked at it more in detail on stock by stock basis, I've been a bit skeptic on the content of these companies. So we have decided to stay away from that. And that's also an index like investment should be a bit about risk management and less risky. So I think we leave that particular segment for the more pure play niche funds.
Great, thank you. We have 2 more questions here. Do the new MSCI climate change indices have similar tracking error to your fund? And why don't you use MSCI Paris Aligned as a benchmark is the first one.
Yeah, so they have launched several different strategies. They started with one which was not labeled as Paris Aligned, but it was labeled climate change, which was the first one. And then they made one which is Paris Aligned, and it's tilting the weights. So they don't do risk management. They just increase the weights by a factor of 3 for climate solutions and down by a factor of something for fossil, etc. And then lastly, they have another version which is also doing tracking error minimization. So the last one is more, they are using more of the tools that we are also using. So first, then you need to, it's a bit confusing because they have many different versions, and in terms of returns, they have been really different also. Those 3 versions last year, they had an excess performance of 2%, 4%, and 6%, right? So it's a lot of differences because the signal they use, like the climate indicator that goes into it, is identical. So it's only about portfolio construction methodology, which is different. And when you can then get 2, 4, or 6% return on top of MSCI World, it just shows that this is not a passive choice. You can't say that one of those is correct and the others is an active choice. So to me, to use one of those as our index, it's philosophically speaking not correct, because their strategies are full of subjective choices. They have 3 different ones that don't agree at all, right? So why should you pick one of them and say that this is now our benchmark? So for me, they are doing the same as we are doing, trying to make a good substitute for index money, which can go into a climate aligned strategy. So I would rather see them as a peer than as a benchmark. So for me, it would be equally relevant to take another fund, so not an index, but a fund, and say this is now my benchmark. And because we are all trying to do the same thing, and they just have taken a particular part of the value chain, saying that we stop when we have made the buying list of stocks. But that's also part of what we are doing. So they have just taken out one step of our process and said that we'll stop here, and then other asset managers can replicate it. And I far prefer to have ownership to the entire value chain, because we can iterate and evolve. So when we started our fund, then MSCI's best climate fund was low carbon tilted funds. And then they and others realized that this was a too easy approach. So they have been iterating and producing many new strategies over the years. But for me, an index is too static. It's not fit for purpose, because climate change is a rapidly developing field. Many new insights and data sets becoming available all the time. So to stay on top of that, I think it's good to have a vehicle that can evolve together with it, like we have, because we have full ownership to it. And during Q1, there was an interesting case of this, actually, with an iShares ETF, which tracks an S&P clean energy index, which only had 40 companies. And they had huge inflows due to the spectacular performance of clean energy companies. But the index was not liquid enough at all. So it meant that they got into trouble with buying far too high part of the market. So they sort of cornered the market in these shares. And then they wanted to increase the liquidity in the index. But the asset manager couldn't do that, because the index was produced by someone else, right? So they had to call them up and describe the problem. And then the index provider had to make a public consultation round on changing the methodology, because they had sold their products to many asset managers and they couldn't just change it for one. So then it was discussed in public that no, we have huge liquidity issues because we have a too narrow portfolio and too many assets tracking it. And then, of course, hedge funds, they were happy about this, because then they could front run this rebalance trade because it was public information by design. So I think it's actually a lot better to have this entire value chain within one house, so that if we need to do modifications, we are free to do so. And if we need to manage liquidity risk, we can do so without writing it in the paper up front. Yeah, so that's my take on that.
We have 2 more questions, actually, so I'm going to try to be quick. We have maximum 5 more minutes, but isn't the 10% climate solutions highly correlated with energy prices and the remaining 90% low carbon emitting companies?
The first thing is that so far, at least, the renewable electricity companies have been more sensitive to political sentiment and subsidy regimes. So the main driver of those have been, if you look at which days are those companies jumping up and down a lot, and that's when you have announcements regarding subsidy regimes. Whereas oil companies are driven by OPEC news and demand news. So far, at least, the statistical correlation between them have not been that high, as far as I'm aware. So it's sort of the stick and the carrot are not always used at the same time, so to say. If they were, then they would become more correlated, but it's usually separate processes. And for the rest of the fund, it is more low carbon in the sense that we are fossil free, for sure. But we also have then built in this new preference for FTSE green revenue, so green exposure, EU taxonomy motivated. So parts of those 90% are also exposed to climate solutions, just not in as pure play as this 10% allocation. But a good part of having this allocation within the entire fund is that you can do risk management for accommodating the presence of those 10%. You can modify the rest, the 90% rest of the fund, by buying less small caps there and managing exposure to currencies and beta to market and your exposure to value and momentum, etc., to neutralize a bit of the risk that you would otherwise take on from investing in the clean tech segment. So risk management wise, it's a good thing to have it integrated also into one fund.
Great, and I guess last question, 2 minutes. How do you see the EU taxonomy affecting how you work, actually? Yeah.
So the EU taxonomy is turning into be a quite detailed description of a lot of the various industries. They have now, I think, 600-page document describing this. And the motivation they have is the same that we had in 2017 when we started investing in climate solution stocks. We also made our own classification of which product types are needed and who stand to benefit from this. So we can use it as a source of inspiration for new ideas of which companies are relevant here. It's also triggers a lot of new products like the FTSE green revenue product. But our definition of climate solution companies is a lot more narrow than the EU taxonomy. Their goal is to make investments available to all of the different companies needed for Paris Agreement, but they are really broad in the definition as well. For instance, they include real estate operators who just buy and hold buildings as long as those buildings are energy efficient. And for me, that's primarily a bet on the real estate market, not on climate change mitigation. So that doesn't qualify for our need. I rather increase the exposure to heat pump companies, to insulation material companies, those which are pure play on selling products that the real estate operator needs for their energy efficiency calculation. So we're a lot more strict, so to say, than EU taxonomy. But of course, it becomes a standardized metric that you can talk about and probably communicate to clients and compare between products, but not green and not green is not binary to me. It's not just 1 and 0 like for EU taxonomy. There are also big degrees of differences in how high is your exposure to Paris Agreement within different green companies.
Well, great. Thank you for the answer. I don't see any more questions here or on email, so I think we've covered everything. Just a reminder, as I said earlier, we're going to send out the presentations following this call, and we'll also send out a link eventually of the recording. But thank you to everybody who participated. It was great to see so many could make it. And thank you, Henrik, for a very good introduction and cover up the first quarter of 2021.
Thanks a lot. Have a nice day.